May 18th, 2012, 11:05 a.m. The most anticipated IPO in history is 30 seconds from going live. Then the number doesn't come. Not late, not delayed, gone. The machine that was supposed to open trading just stops answering. Somewhere inside Nasdaq's matching engine, a system built to protect investors is now fighting itself. And nobody on the trading floor knows it yet. By the end of the day, 3 million Facebook shares will sit in Nasdaq's own account. Nasdaq won't know this for almost 2 hours. This is the autopsy. Here's the machine, in plain terms. Nasdaq's IPO Cross Application takes every buy order and every sell order. It finds the single price that matches the most shares. It prints that price. Normally, this takes 1 to 2 milliseconds. Built into it is a safety check. Before the price prints, the system asks itself one question. Did any order used in this calculation get canceled in the last few milliseconds? If yes, recalculate. Make sure the print is accurate. That's the half of the system everyone understood. Here's the half nobody had tested. The recalculation only absorbs one cancellation at a time. 2 cancellations arrive together. The system catches the first, runs again, and the second one is already stale. Fail. Recalculate. Fail again. Under normal volume, this resolves in milliseconds. Nobody notices. Facebook's IPO was not normal volume. Nasdaq knew this IPO would be the biggest test the system had ever faced. They rehearsed it. A test ticker capped at 40,000 dummy orders to simulate the load. Real traders submitted 496,000 orders, 12 times the rehearsal, into a recalculation function that had never been stress tested past a handful of cancellations at once. 11:05:10 a.m. Nasdaq triggers the cross. A cancellation lands mid-calculation. Recalculate. 2 more arrive. The system absorbs one, fails on the other. Recalculate. 4 more land, then more. The system never crashes. It never throws an error. It just keeps recalculating, forever. One step behind a flood it can't catch up to. Nasdaq had a name for this. A loop. The opening price isn't late. It's stuck inside a machine that is now mathematically incapable of finishing. At 11:05, Nasdaq's senior leadership convenes an emergency call. Internally, they call it Code Blue. The CEO of Nasdaq OMX is on it. So is the head of trading technology. So is the head of market regulation. None of them know why the cross has failed. A few minutes in, engineers report back. The validation check is blocking the print. They don't know why it's failing. They only know it is. So leadership orders a fix. First attempt, override the validation check directly. Fails. Second idea is the one that changes everything. Switch to a backup matching engine, but not a clean copy, a modified one. Strip the validation check out of it entirely. Let it accept whatever price the cross calculated, no questions asked. Nasdaq had backup systems. They'd built them for power outages. Nobody had ever used one to deploy altered code in the middle of a live crisis. At 11:25 a.m., the executive vice president for transactions approves it. In minutes. With no one on that call knowing what actually broke in the first place. Here's what that decision actually meant, and it's the detail that should make every engineer in the audience sit up. Removing the validation check doesn't make the canceled orders disappear. It means Nasdaq itself absorbs them, takes the other side of every mismatch, becomes a trader in its own auction. Nasdaq expected this exposure to be small, a fraction of a second's worth of noise. They had no idea how long that fraction of a second actually was. 11:39 a.m. The failover executes. The price finally prints. 75.7 million shares, $42 each. Trading begins. For about 90 minutes, it looks like a crisis survived. Then Nasdaq discovers what the loop actually cost them. The matching engine hadn't been stuck for milliseconds. It had been stuck for 19 minutes. The price that opened Facebook stock to the world was calculated using orders only up to 11:11 a.m., not 11:30. More than 38,000 orders fell into that 19-minute gap. About 8,000 re-entered the market when trading resumed. The other 30,000 were frozen, not executed, not canceled, not confirmed, just gone, as far as anyone who placed them knew. And because more sell orders than buy orders had been canceled inside that gap, the position Nasdaq absorbed wasn't a rounding error. It was a short position. 3 million Facebook shares, roughly $129 million. In a stock Nasdaq's own rules forbade it from holding. They still didn't know this, not for another 2 hours. Within seconds of that opening print, a second system failed. Confirmations stopped going out. Traders who'd placed orders in the cross had no idea if they owned Facebook stock, how much, or at what price. The cause traces straight back to the failover decision. Nasdaq's confirmation system had been watching the order book the entire time, untouched by the loop. It expected the printed price to match everything submitted up to 11:30:09. It didn't, because the price only reflected orders up to 11:11. The system flagged the entire cross as an error and refused to release a single confirmation. For 2.5 hours, every Nasdaq member trading Facebook was trading blind. At 12:01 p.m., the CEO of a major market-making firm emailed Nasdaq's CEO directly. "We are trading blind. Should you halt the market so we can understand our exposure?" Nasdaq read it. Nasdaq didn't halt. They'd already decided at 11:35 that nothing extraordinary was happening, because trading looked active on the surface. They never revisited that call. Not after 2 failed attempts to force the confirmations out. Not after a market maker's CEO told them, in writing, that the entire market was flying blind. 49:49 p.m. Almost 2.5 hours after the cross, Nasdaq finally forces the confirmations out by reconfiguring the system to simply ignore its own error. In the same instant, the 30,000 stuck orders are released or canceled. 13,000 hit the market at once, almost all on the sell side. The largest imbalance of the entire trading day. Facebook's price drops 93 cents in 60 seconds. Every one of those 30,000 orders had been waiting since 11:05. Every one of them lost priority to trades placed after them. Nasdaq's most basic promise to its own members, first in line, first filled, broken for all 30,000. And the position. Nasdaq covers its short before the close. Facebook's price had fallen since the open. Nasdaq profits approximately $10.8 million from a position its own rulebook explicitly forbade it from holding in the first place. In May 2013, the SEC charged Nasdaq $10 million, the largest penalty ever levied against a stock exchange at that point in history. But the fine isn't the real finding. The SEC's language was specific. Nasdaq launched trading before fully understanding the problem. Senior leadership approved a fix to a system whose root cause nobody on the call could explain. They deleted a safeguard without knowing what it was protecting against. That's not a glitch. That's improvisation at the center of the national market system during the most watched 15 minutes in market history. So what actually broke on May 18, 2012? Not the market, not investor demand, not Facebook. What broke was the assumption that 12 times the rehearsed volume would just mean more of the same problem, scaled up. Nasdaq was wrong by an order of magnitude they never modeled for. What broke after that was worse. A room full of senior executives, under enormous public pressure, approved a fix to a system they didn't understand, because doing something felt safer than admitting they had no idea what was happening. They were right that something needed to happen. They were wrong about which 19 minutes they were betting on. Subscribe to the White Collar Autopsy. We'll see you in the next dissection.